Markets are often assumed to function efficiently, but history has repeatedly shown cases where they have failed, leading to major financial disruptions. Understanding these failures is essential for traders and investors to anticipate risks and develop strategies that mitigate potential losses. By analyzing past market collapses, traders can identify patterns and warning signs that indicate instability. Learning from these failures helps in strengthening risk management practices and adapting to market volatility. Market failure occurs when the free market is unable to allocate resources efficiently, resulting in suboptimal economic outcomes. Several factors contribute to market failures, including externalities, where economic activities impact third parties without compensation. Information asymmetry arises when one party has more knowledge than another, leading to imbalanced transactions. Issues like public goods and the free rider problem, market monopolies, and inefficiencies in government intervention can further distort economic balance. The 2008 financial crisis was triggered by the collapse of the housing bubble, fueled by excessive risk-taking, subprime lending, and complex financial engineering. One of the key factors was moral hazard, where banks engaged in risky behavior, believing they were too big to fail. Information asymmetry played a role, as investors did not fully understand the risks associated with mortgage-backed securities. Additionally, regulatory failures allowed financial institutions to operate with minimal oversight, increasing market instability. Lessons from this crisis highlight the importance of financial regulations, effective risk management in banking, and greater transparency in financial products to prevent future economic disruptions. The dot-com bubble from 1995 to 2001 was fueled by the rapid rise and fall of internet-based companies, leading to a significant stock market crash. Key factors included the overvaluation of technology stocks, where investors poured money into companies with little to no earnings. Herd behavior among investors drove stock prices even higher, ignoring the lack of sustainable business models. The lessons learned emphasize the importance of fundamental analysis in investing, prioritizing sustainable business models over hype-driven investments. Additionally, understanding market cycles and investor psychology can help avoid similar speculative bubbles in the future. The Enron scandal of 2001 was one of the largest corporate fraud cases in history, involving widespread accounting fraud and financial manipulation. Key factors included the use of accounting loopholes and fraudulent financial reporting, a lack of corporate governance, and serious ethical failures in leadership. The case highlighted the importance of corporate transparency and ethical decision-making in financial institutions. It led to the strengthening of accounting standards through the Sarbanes-Oxley Act, which increased regulatory requirements for financial disclosures. Additionally, it underscored the crucial role of independent auditors and regulatory oversight in preventing corporate fraud. Understanding past market failures allows traders to recognize potential risks and warning signs in financial markets. By analyzing financial bubbles and speculative excess, investors can avoid entering high-risk trades. Identifying overhyped stocks with weak fundamentals helps prevent speculative losses, while studying corporate fraud cases guides investors toward companies with transparency and strong governance. Learning from historical crises enables traders to position themselves strategically before market downturns or corrections. Market failures provide important lessons in financial governance, risk management, and investor behavior. By studying past failures, traders and policymakers can identify weaknesses in the system and implement strategies to mitigate future risks. Understanding how previous crises unfolded helps businesses and individuals make more informed financial decisions. Effective regulations, transparency, and responsible investment practices can prevent similar market disruptions in the future. Learning from historical mistakes strengthens the resilience of financial markets and contributes to long-term stability.